what they've been doing all year. They print the hot number on the front end, and then they revise the number the next 2 or 3 months. So my guess is that they probably revised previous months again, to the point of why? Why do you want to cause breakage?
Strategists at Bank of America Corporation recently got their hands on U.S. bond market data going back to the founding of the nation. And it shows, they say, that never before has there been an extended period of losses like the past 3 years. It's hard to know, of course, just how accurate the figures were from those early post-colonial years. How often could bonds have been traded during the War of 1812? Still, something is jarring about a worse than 236 years statistic. It's a poignant reminder of the magnitude of the pain rippling through the financial world in the aftermath of an inflation shock and interest rate surge that few saw coming. The pain was severe enough to take down Silicon Valley Bank and 3 other regional lenders this year and pushed others into crisis until policymakers in Washington rushed to prop them up. Mark Yusko believes this is all a result of various stupid policies made in the past. He also talks about other various indicators of economic slowdown. We are now going to jump right into it. Don't forget to hit the like button, subscribe, and drop your comments below.
This is the quote-unquote risk-free asset. Now, okay, long-duration bonds are not risk-free.
Right.
Well, but treasuries are not, supposed to default. But what people are getting a quick lesson in here is what happens with duration when interest rates normalize. And I use that term very intentionally in that, we had, I think, stupid, like a better term, policy for way too long with this whole QE, zero, ZERP kind of, bail out the banks fiasco. But here's the problem, right? Is I don't know if you have this chart or not, but the CDS, credit default swaps on banks, have blown out. And there's going to be a whole bunch of banks floating to the surface, like dead. And like dynamiting a river, right? The fish just float to the top. And it's ugly. And basically that was caused by, again, idiotic in hindsight, actually in foresight, it was idiotic, plan where you forced the banks to borrow from the Fed at zero and buy treasuries, right? That was the plan because there were no buyers of treasuries and they wanted to do this MMT thing and this big fiscal spend. And so, okay, who's going to buy the bonds? Well, Japanese aren't buying them. The Russians aren't buying them. So, okay, you bank, you buy them. And it was free money for a long time. Borrow at 0, invest at 3, lever up 10 times. Love it. Okay, now rates go from 0 to 5. Oh shit. I got big losses. And we saw SVB. Well, now it's beyond SVB. I mean, regional banks all over this fine country of ours are about to just get obliterated. And then what happens? And this is the part that I don't want to be too alarmist and too scary, but if they then can't buy, who's going to buy all the bonds? Because I think what has happened in the past month is the bond market's like, well, shit, there's no one to buy my stuff. So I got to offer higher rates to clear the market. I mean, that's what it feels like to me.
Also, guys, if you want to stay most up to date on the crypto world, there is a daily 5-minute crypto newsletter that covers expert predictions, on-chain data breakdowns, and breaking news, all for free. It's called the Crypto Nutshell. Click the first link in the description, enter your email, and join 10,000 plus others to become a better crypto investor right now. Now here's Speaker with his Bitcoin forecast. A strong jobs market could equal a weak stock market if current trends hold up. Friday's non-farm payrolls report will provide a major test for Wall Street, which has been on edge all week about a surprisingly resilient labor picture. The fear is that if the tight labor market holds up, the Federal Reserve will hold interest rates high and jeopardize the U.S. economy at a critical time. Some may be wondering what non-farm payroll is and how it affects them. Non-farm payrolls refer to the total number of workers in the U.S., excluding farm workers and a few other job categories like private household employees, nonprofit organization workers, and government employees. Each month, the U.S. Department of Labor releases a report on the number of non-farm payroll jobs added or lost, which is a key indicator of the overall health of the country's economy. A significant increase suggests economic growth, while a significant drop could indicate a downturn. Many investors and policymakers closely watch this data to gauge the economy's direction. Now let's continue with the video as Mark Yusko discusses the Santa Claus rally. Does that sound strange to you? Well, sit upright and hear what he has to say.
We peaked in July. So we peaked July 28th, and we've given back almost half, not quite half, almost half of the gains for the year. Could we go all the way back to zero for the year? Yeah, we could. Everybody said, oh no, the Santa Claus rally is coming. The Santa Claus rally exists in years where you have big losses in certain sectors, and there's a rebalancing, and it usually happens in October. So October 31st, or no, I'm sorry, it happens in November. So October 31st is the deadline for mutual funds to make sales for the current year. It used to be 12/31, they moved it back to 10/31. And so what happens every year is, it used to be the last week of October, and then some people tried to game it, and they did the third week of October, and then some do the second. So starting, around next week, people will start selling the losers. They have to wait 30 days to avoid a wash sale, and then they buy them back. And that used to happen the last week of December into January, and there was something called the January effect. So small cap stocks and the things that had performed poorly the previous year had this big face melting rally in January. It's called the January effect. And then it disappeared when they changed the law and it moved to November. And that's now what they call the Santa Claus rally, because it happens toward the Thanksgiving time into Christmas time. And everyone's, oh, this is great. Like, well, it only works when there is a dislocation in some segment of the market that people can rotate into in these big giant mutual funds. In a year like this year, where everything's up or flat, so you got most things are flat, and you got the Magnificent Seven up, what's going to get sold to tax loss harvest? Nothing. And then what are you going to buy back in November? Nothing. So I just don't think there's any impetus for the Santa Claus rally or the January or the November effect, I guess now it's called. And so I think what we have now is we have no tailwind, and we have increasing headwinds, particularly this interest rate thing. It's possible. I'm not predicting this. I'm not saying it's going to. It's possible that they've lost control of the long end. Right? It's possible. And they don't really control the long end like they do the short end, where they can, change rates. But in theory, you lasso the long end with the short end, and you kind of hold it, up or down but it's possible that they've lost it. And the supply and demand problem is going to overwhelm the market. And there was somebody who was Ron, what's the guy? He's on CNBC. He's got the glasses. Oh God, what's his name? It's not DeSantis, right? That's the political guy, but whatever, Santori. Anyway, so he was saying in a segment that rates could go to 13%. I'm like, okay, why is he doing that? Why is he doing that? Is that a talking point? Has he been told to say that? Is that just an extrapolation of the current trend? I mean, what? That was weird. That to me felt like what you do with propaganda, right? You put something way out extreme to seed the idea, and then you start repeating it.
Investor enthusiasm over AI potential to boost productivity and usher in a new era of growth helped the stock market rebound from 2022's brutal drop throughout the first half of this year. Even as the Federal Reserve hiked interest rates to fight inflation, the S&P 500 jumped roughly 20% to briefly touch 4,600 at the end of July. For Ed Yardeni, the founder of Yardeni Research, the stock market's surge was expected but ahead of schedule, and that meant a near-term pullback was on the way. We concluded that the S&P 500 index might fall to its 200 days moving average, which is currently around 4,200, The veteran investment strategist, economist, and former Fed official recalled in a Sunday note. Since then, the S&P 500 has done just that, or thereabouts, dropping some 7% to 4,280 by midday on Monday. Yardney believes the index could easily drop down to his forecast of 4,200 during October as well, but after that, he expects a comeback. We see a year-end Santa Claus rally back to 4,600 or close to that level, he explained, quickly adding that this assumes there isn't an extended auto strike, a government shutdown, or surprising credit losses at the banks. Despite concerns over the effects of rising borrowing costs on banks and other firms, Yardney argued that the third quarter earnings season will likely be much better than widely expected, and S&P 500 operating earnings per share will hit a record high by the end of the year. Yardney appears very optimistic about the Santa Claus rally, and so does everyone, including Mark Yusko. But what happens if it doesn't go as predicted? What becomes your next action? Let us know in the comments section below. Make sure to hit that like button, subscribe, and turn on notifications. Thanks for watching.